Welcome to the podcast.
Yeah. Oh, man. Okay.
Who do we have today?
Welcome to the pod. Yeah. Let's start now.
Go.
You do it. You do it. You do it.
Welcome to the podcast. Today we've got Josh, and it's been another round two, right?
It's round two. We did this with Josh before, and it's been a journey to figure out mics and the proper mic setups. And when we did it with Josh before, the mics did not work at all, and it was unusable.
Okay, and this is great. Great timing for my terrible medium-term memory because I don't really remember much what we talked about. So I'm probably going to ask a lot of the same questions, and it's going to come off super genuine because I honestly don't remember.
I was actually thinking the same thing this morning. I think it's been long enough that we've all kind of forgotten the conversation. So
yeah, Josh, you want to tell us what you do?
So I'm a business broker and M&A advisor. I help people buy and sell businesses, mergers and acquisitions.
Nailed it.
M&A.
Yeah, M&A cotton. Yeah, so Josh, in case you didn't realize or see it immediately, is my brother. He's my older brother. He's the smarter brother, master's in finance, all the things. Yeah, has owned a few businesses, done the whole thing. But business brokers, yeah, you help people mostly sell their businesses. But what's kind of the process? So let's just do the 30,000 foot view, the real selling businesses for dummies version of it. What does the process look like if somebody owns a business and decides, hey, I want to figure out what I could maybe get for this?
Yeah. So there are several distinct steps in the process. So first, we want to take a look at evaluation for the business. And that's going to be based on the cash flows of the business that are available to a buyer. And most small businesses sell for a multiple of those cash flows, typically between 2 and 5 times the cash flows.
Okay. What determines whether it's 2 or 5?
The size of the business, the industry of the business, how dependent on the owner the business is, all of those things factor in.
So if it's a giant business and it's completely dependent on the owner, it jumps up to a 93. Right?
Actually goes the other way. The more dependent it is, probably going to have a lower multiple.
So it's just one business that was 93 times the...
Yes.
Okay.
I see where you're going with that, yes.
SpaceX.
Oh, got it. Took me a second.
Yep. Yeah. Nice. Okay, so how do you determine the cash flow? Is it, if owners are keeping good books, is that relatively easy to determine? And also, how common is it for owners to keep good books?
Not super common for owners to keep good books. I see a lot of owners with really messy books, and running a business is hard. Most owners would probably benefit from having a bookkeeper and having better systems around maintaining their financials, and they would have better information to run their business.
Yeah.
If they do have really good, clean books, the way that we determine the cash flow is we'll take the business tax returns, and the net income on the tax returns is kind of the starting point. And then we work back to EBITDA, which is earnings before interest, taxes, depreciation, amortization. We add those things back, and what that gives you, those are kind of non-cash or discretionary things that are removed from the income for taxes, right?
Okay.
And so what that does gives us EBITDA, and then from there, if it's a smaller business, we'll do, some applicable add backs, like do they have a car, do they have personal cell phones, things like that are running through the business that aren't necessarily related to the operations of the business. Mm-hmm. And then for smaller businesses, we'll add back one full-time owner's salary. And so that we call that SDE, or seller's discretionary earnings. Mm-hmm. And what that represents is really the cash flow available to a buyer. So on a smaller business, if I'm a buyer and I'm coming in, I want to know that SDE number because I know how much cash the business generates, how much cash I have available to pay on a loan that I take out to buy the business, and how much cash I have available to pay myself to be a full-time owner. On larger businesses, then we base it off of EBITDA, which the assumption there is you're buying that business as an asset. It has the management in place to operate the business.
Gotcha. So, as a small business owner and working with a lot of small business owners who are buying houses, it's like we take every deduction we can. We're just like, okay, what do we need? It's at the end of the year. What do we want to buy so that we pay the least amount of taxes this year? But then you try to plan ahead a little bit if you're going to buy a house, so that it's like, okay, like we can't look like yeah. And so usually about 2 years we say like, okay, like don't take all, like pay a little bit more taxes. You got to look like you've got enough income to buy this house. Are there kind of guidelines like that if you're thinking about selling your business that are kind of similar?
Yeah, it's very similar. So, for most of the time that an owner is running their business, they want to minimize those taxes.
Right.
But typically 3 years before they need to sell is a good time to start taking a look at, hey, you may save a couple $1,000s by writing everything off. But if you leave those things in and you pay that couple $1,000s in taxes, you're going to get, 2 to 5 times that cash flow that you're showing as profits in the sale of the business. So you may get, 10,000 in benefit when you sell the business if you just pay 1,000 or 2,000 in taxes.
So if people are like starting to think about, hey, I've had this business for 20 years, I'm getting ready to retire, it feels like there's a large wave of like boomers specifically that own businesses that are going to be retiring and trying to sell them soon.
Yeah.
So they should be thinking like 2 years. How many years do you typically go back when you're looking at?
3 to 5.
Okay.
Typically 3. On some businesses, we'll look back 5 years.
So if you're getting to retirement age and you want to be done with your business, you should be looking 3 years down the road and start really like talking to a business broker to be able to plan that effectively.
Yeah, and it's going to take some planning and some discussions with, your CPA, because they're going to be focused on, hey, how do we, legally minimize the taxes that you have to pay? But there's some strategy to it as you get closer to it being time to sell, where you want to leave some of that in so that you can get a higher sale price.
Okay.
Nice.
Also, in real estate, it seems like most of the deals we do, it's like, okay, like we deal with sellers, we deal with buyers, and it's usually somebody who has a need or a want, and they come to us and we help facilitate that need or a want. Every once in a while, if there's a need or a want for a buyer and we're not finding that on the marketplace, people will start sending mailers or door knockers like, hey, we've got a buyer, we want something like this. And then sometimes you've got 2 people that are like neighbors or like, hey, my cousin wants to buy our house. We weren't going to put it on the MLS, but like something that's kind of not worked out, but like 2 people who kind of, they want to figure something out, and it's not necessarily that they're going out. What's that like in your industry? Does that happen very often where it's like, oh, my son wants to buy my business, or my buddy wants to buy my business, or we need some money, we want to sell part of our business? And how is that different from like going out and slinging somebody's business who's planned ahead? You know what I mean?
Yeah. So the SBA is a big driver in that, and those things do happen for sure.
SBA is?
Small Business Administration. And the reason that they weigh heavily on those decisions is the Small Business Administration, SBA, offers what's called a 7A loan, which can be used to acquire a business based on the cash flows of the business. But they have a lot of rules and requirements that go into it. If a buyer is using an SBA loan, there's typically a pretty strict restriction on the seller remaining in the business as a partner, or even, for any period of time.
Got it.
So if a buyer needs to use an SBA loan to purchase the business, then it has to be basically a complete change in ownership.
Yeah.
I know you've told me about somewhere like they'll work out a contract where the owner will stay on in an advisory role for like a year or something, just to help the new, like if it's a completely new industry for somebody and they move into it. Like you had your printing business and the owner stayed on for a little bit and
Yes.
helped learn that, right?
Yeah.
Yeah. How does that work with that SBA stuff?
A transition period is a normal thing, and it's usually right in the purchase agreement for the business, and so the SBA is fine with that. Like, it's an understood thing that, you know, when a buyer buys a business, they're going to need to work with the seller for some period of time, usually, you know, 2 or 3 months.
They just have to give up the ownership of it.
They have to give up the ownership, yeah. And then, you know, there's usually something in the contract where the seller is available for calls and consultations for up to a year.
Nice. Okay. Yeah. So, I mean, with this potential, like, we're already kind of seeing it, right? Like, a lot of boomers are selling their businesses that they built from the ground up starting in the, like, 70s. If somebody were to approach you and say, hey, I really want to find this specific type of business, how does it work? So we know you like list businesses. How does it work with buyers? How do you help with that?
For buyers, what I can do is, you know, I can let them know of any businesses that are coming down the pipeline that are going to be listing soon that might line up with their search criteria. I can also add, you know, their search criteria to my outreach efforts. You know, I'm always talking to business owners, seeing when they want to sell their business, helping them get prepared, you know, if they're within a few years of being ready to sell. And then there's some great resources too. You know, there are books, there are podcasts, there are websites that have a lot of really great information for buyers who are getting ready to go through that process.
Nice.
What is the dynamic like? I imagine with people who would want to buy a business and they're looking for something, it's like, okay, there's the left brain numbers, like, this is kind of my investment, this is what I can do, I'd like something to see this kind of return. And I imagine, I mean, same with home purchases, it can be an emotional thing where somebody's like, I don't know anything about the restaurant business, but I want to start a restaurant, can you find me a restaurant? Versus, well, the amount of money you're willing to put up, like, have you checked out snow cone stands? You know, or you know, something that like maybe that you have experience going, okay, statistically these things do a lot better than others. What's the dynamic like that? And what do you have to coach buyers that way a lot?
And also, as somebody who's owned a restaurant.
Yes.
Oh, okay, yeah. That was kind of the
I've been there.
That was kind of the follow-up question too. Is were you a business owner before you did this? And if so, how has that kind of helped? And what in what you're doing as you're helping people navigate that process?
Yeah, so that circles back to SBA loans and some of the requirements that are there. SBA lenders are going to want to see that a buyer has some experience in the industry where they want to buy the business.
Yeah.
That being said, you know, buyers can buy if they have experience that they can apply from another industry that makes sense in, you know, their target industry or the target business, then that can work. Another point, you know, you mentioned, hey, maybe like size down a little bit. One of the requirements of getting that SBA loan is it has to be 10% down from the buyer.
Right.
In most cases. There are some exceptions, but in most cases. So if you want to buy a $5 million business, which is the upper limit of the SBA 7A loan, then you're going to need $500,000 to put down to purchase the business and get that loan. So industry experience, having that down payment, those are like clear signs to a business broker and to a seller that this is maybe not an experienced buyer, but a qualified buyer who's going to be able to get a deal done.
Right.
Nice. Yeah. Now, from the sales side, like, I mean, just because I think this stat is interesting, the restaurant side, what is the failure rate of restaurants? I feel like I've had a bunch of friends come to me and be like, hey, I think we should open a coffee shop or a restaurant. And I always quote a stat that you told me, lean into it. Restaurants are a risky one, right?
Yeah, I mean, most restaurants aren't going to make it beyond 2 to 5 years.
Yeah.
Like, those are the statistics. But interestingly, not a lot of SBA loans for restaurants fail.
Oh.
Now, that could be because it's somebody coming in and buying a well-established restaurant that, you know, as long as they don't mess things up, has the opportunity to keep going and being a profitable business. And then, the other side of it is maybe the restaurant doesn't do well, but the owner, gets a job in something else or has a business somewhere else and continues to pay on that loan.
Okay.
But yeah, not a lot of restaurant SBA loans.
Oh, that's interesting.
Go bad.
This isn't a Carvana situation.
Yeah.
I wonder if some of it has to do with too that like so much of the equipment or things like that, like assets seem like they're typically things like real estate or equipment that holds its value, or the other things are perishables and they're gonna go bad in a couple days anyway, and the pay is usually based on tips, so there aren't, if the thing goes under, you're not paying out 20 servers 3 months of severance pay or whatever.
Right.
Yeah.
Now, that's an interesting thing when we look at valuations is we do look at, so typically real estate is going to be separate from the business transaction. We can sell real estate along with the business, but it's not going to factor into the valuation of the business.
Great, yeah. Kind of like personal property with real estate transactions.
Yeah. But what does factor in is the value of the assets. Mm-hmm. So that's something that when I do a valuation for a business, I'm looking at, hey, if a restaurant has $600,000 worth of equipment, and that's if they went out to sell that equipment right now, not what they paid for it. Mm-hmm. Like if that equipment right now is worth $600,000, then we're going to look at that versus evaluation based on the cash flow. If the business has good cash flows, then hopefully those cash flows are worth $1 million plus instead of, and then we're going to sell it based on the cash flows instead of that $600,000. If the cash flows are only worth $500,000, then it makes more sense for the owner to sell the equipment than to sell the business.
Have you come into the kind of scenario where the cash flow of the business depends so much on the real estate that it's in, and so where you're maybe not going to get approval on the SBA loan if it doesn't come along with the parcel?
So like quick example, like are you thinking of your the studio where you own the building and you have a separate space that you rent out to somebody else, so that technically factors into
or even something like, not that the zoo or whatever. Like there's something where it's like it's the reason it is what it is. It's like the Cliff Lodge, it's a place. It's got the magic view, and the reason they do well is because you go in and you've got a great view. It's called the Cliff Lodge. I imagine if the Cliff Lodge was going to sell, the parcel that it's sitting on has a lot. Anyway, I didn't know if you have any insight there on that kind of thing.
Yeah, if you tried to relocate the Cliff Lodge, it would not carry the same value, right? I would say that most small businesses, that's not the case.
Yeah.
Most small businesses, manufacturers, they can find another warehouse if they don't like the current warehouse or if they outgrow it. Some buyers don't like to buy the real estate because they're buying this business with the plan to grow it. And if they're going to outgrow it and need more space, they just want to lease the space they're in.
Yeah.
And so we do see, some sale leaseback structures in the commercial real estate side of some of these transactions.
Awesome.
Now, where the valuation is just based on the business and not necessarily the real estate, does SBA, would an SBA loan wrap and cover the real estate as well, or do you have to do a separate commercial loan?
Yeah, so there is a different SBA program called the 504 loan that is better suited for real estate, commercial real estate.
Okay, I think that's what we get.
Nice.
Yeah, there you go. So you could do $2.5 million on a 7A loan for the acquisition. You can do up to $2.5 million on the 504 loan. And they did just make a change where for certain industries, you can actually combine the $5 million in each program. So you can go up to $10 million.
Oh, wow.
It's a very recent change, but it's exciting.
For only $1 million down.
Yeah, so.
Nice. Okay, let's
option.
get you some, I'm thinking of editing this later, and I want to get you some 1-minute clips. So we're going to do some quick fire round.
All right.
All right, in under 1 minute, if I wanted to list my business, if I wanted to list it next week, what should I do right now?
list your business next week.
Well, okay, if I want to list my business in 3 months, what should I do right now?
In 3 months, first thing you want to do is talk to business brokers, get a valuation, know what your business is worth. And what they'll need to do that valuation is 3 years of tax returns and your year-to-date financial statements, your balance sheet and your profit and loss statement.
Okay.
They'll go through, the business broker will go through, do the valuation for you, and then you've got a decision to make. Are you okay with that valuation? If you have to sell in 3 months, you're probably going to have to be okay with that valuation. If you have more time, then that value is good information for you. You can adjust how you're running the business. You can adjust how you're filing your taxes, whatever you need to do there.
Nice.
But that would be step one.
What are the costs associated with getting your business valuated?
It's all over the place. It can be from, a couple $100 for a quick broker's opinion of value where they're not going to go through, in a lot of detail. They're just going to take your top line numbers and apply a multiple to it. To if you do a professional valuation, so this is not through business brokers. There are companies that specialize in doing valuations for businesses, and those can be $2,000 to $10,000, and for larger, more complex businesses, even more than that. So
Nice.
There's a wide range.
So say a mid-sized business, a $2 million business, whatever, approached you and said, hey, I want to figure out exactly what my business is worth. Do you know roughly how much it would cost them?
How much
you would charge?
it depends on it.
The complexity.
Depends on the complexity of
Yeah.
the business. Yeah.
Okay.
And what level of detail does that business owner want? Do they want something that, hey, we are ready to go to market and start talking to buyers, or do they just want an idea?
Oh, yeah. Nice. If I were shopping for business brokers, like shopping for real estate agents is tricky because everyone talks a big game. Not everybody is good. And some of the people that are good don't talk big games. So it's kind of a crapshoot in that sense. We can demonstrate value to some extent, but with business brokers, if I'm shopping for a good business broker, what should I be watching for?
So a good
The
first
name Josh Jones.
yeah. So a good first like hurdle, I don't know what the right word is.
Yeah. Qualification.
Good first qualification to look for is there are several really good, really reputable organizations across the country that are for business brokers to help professionalize the industry, to do education and conferences and things like that. Sorry.
You're good. Luckily, I can edit the crap out of this. I do it all the time. We all say a lot. It's most of my editing time is cutting out us saying
Nice.
There it is.
There it is. So the IBBA is one of those nationwide business broker organizations. It's the International Business Broker Association, and they have a designation called the CBI, the Certified Business Intermediary. Okay. If you go to the IBBA website and you look in your state and you look at who the CBIs are, that's going to be a good first indicator of who's going to be knowledgeable, professional, and going to be a good advisor for you.
Nice. Do you have any fast
ones.
questions?
I had like that 3-part question that was like my big one.
I think I answered one of them.
I think you did good. Quick. I guess what are some things from being a business owner as well as a business broker? Some things that were either eye-opening, going from one to the other, as well as like things that knowledge that you brought along with you that helped you in the other case.
Yeah, so my background is in finance, worked in corporate finance, worked in investment banking, and then bought barbecue restaurants. So a little bit of a change of pace there. Running the barbecue restaurants was fun, but I actually had way more fun doing the deal to buy the restaurants. And so that was when I was like, hey, maybe I should do brokerage instead of just owning barbecue restaurants. Not just, I mean, it's was a fun business to own.
Yeah. So you and our dad owned them together, and Dad
Yeah.
loved the running of them, and
Yes.
you are a numbers nerd. So
That's right.
yeah.
So, so that's how I got into it, and let's see, things that are
What do you wish
super
most
helpful.
What do you wish most business owners knew? Like, what's the most common tripping point you find for business owners when you're doing evaluation?
Well, let's talk about that, and then let's talk about buyers.
Okay.
So for sellers, the most common thing is they intrinsically know their business, but they don't know the numbers. They do their own books. They're a mess. They're sloppy. They've got, loans out there from 20 years ago that are paid off that are still on their balance sheet. Like, those things are not helping them run their business. And we have to get all those things cleaned up. So if they need to sell in a short time frame, then we're scrambling to get a bookkeeper in to clean up however many years of messy books that we need to be able to go and talk to buyers. Because buyers are going to see messy books and they're going to say, if I can't understand how the business runs from the books and from the tax returns, then I can't feel comfortable taking on a huge loan and monthly debt payments on the hopes that I can replicate what this seller who has owned this business for decades knows intrinsically.
Yeah.
So
Nice.
that's a
And then,
challenge.
what do you want buyers to know?
For buyers, they need to have a really good sales plan. A lot of buyers that I talk to are corporate refugees who have been in the corporate world for their whole
I like
career.
the term corporate refugees.
Yeah. But, it's true. Like, they're sick of corporate and they want to go and buy their own business and own their own business. The challenge there, and especially for, accountants, finance guys, and girls, things like that, is they go in with an operations point of view and think, oh, hey, if I can clean up these operations, this business is going to run so much better. And they neglect the sales side where, hey, if you go in and you make the operations beautiful, but sales slowly fall, you are not going to be successful in this business. You have to go in with a really strong sales plan.
Okay, nice. And then something that we run into in real estate, it's happening a lot lately because mortgage rates are so rough. I'm getting calls on every listing about people wanting to do creative financing. I always warn my sellers creative financing carries some significant risk. So we don't end up doing a lot. I know a lot of people stake their business on it. I'm not willing to open my sellers up to that risk. With business, though, there are kind of more legitimate ways to do creative financing, right? So you can do the SBA loan, but then talk about seller financing. That's fairly common, right?
Yes. So I do a quarterly survey of business brokers with the IBBA. It's called the Market Pulse. And we ask business brokers across the country what their deals look like. And I'd say about 85% of well, let me rephrase that. On the average of all of the deals in our survey, the seller gets 85% of the cash at closing.
Okay.
And so what that means is they're providing 15% on average seller financing. And the reason that that's a common thing is, number one, it makes it easier for the buyer to get an SBA loan. Mm-hmm. It shows that the seller is has some skin in the game. They're showing some confidence in the ongoing prospects of this business. If they sell it for 100% of the cost, the seller gets 100% of the cash at closing. They don't have any interest in that business succeeding. They could know that there is a cliff coming for this business, sell it and walk away, and the buyer is left holding the bag. Mm-hmm. So that is a common thing in business sales. And then it can be all the way up to 100% seller financing, in a case where they've got messy books and they, whatever the case may be, they're in a huge hurry, the business doesn't look great. There may be a 100% seller financing solution where, it's not ideal probably for the seller because they are acting as the bank, but it can, provide them income and move the business on to a buyer who can take it from there.
Nice. So with we'll wrap up soon, but with let's say $1 million deal, and the seller provides 15% financing, what should a buyer expect to be bringing to the table for that deal?
So $1 million deal, I always tell buyers plan on bringing $100,000.
Yeah.
Now, if the seller provides 15% financing and the loan is then, $850, the requirement is going to be that they bring $85,000 as the down payment. Now, there are still going to be, closing fees with the bank. There's going to be due diligence costs, their accountant, their attorney, the buyer's accountant, buyer's attorney, some ancillary fees like that they just need to be prepared for. It's usually, in the $10,000 to $15,000 range.
Okay. Yeah. So there are ways that people could potentially buy businesses without necessarily having the full 10% down. It's just good guideline is 10%.
Yeah,
Nice.
absolutely.
All right. Do you have any other questions?
I don't think so. That was really good.
I think I can pull at least 3 or 4 clips from that whole thing,
Sweet,
right?
yeah.
Nobody watches the full thing. I think our
That's the
full ones
clips.
have like one view, and it's
Yeah.
usually me, just quality control.
Yeah.
Yeah.
That's great.
Nice. Okay. Anything else that we didn't ask?
No, I think that's good.
Nice work.
Sweet.
One thing that I noticed from our last
Not
one.
notice either of our
Yeah.
high fives. There we go. There's a clip.
One thing that I noticed from the last one, and I realized that I was doing it again halfway, is I sit with my hands like this, and
Just looks like you're playing
on the
with
video
yourself.
last time, it looked like I was just holding my wiener.
Dude, this last
Like crap.
music video we
Rip
did,
it and rip it.
I was playing guitar, and it was a shot of my face slowly zooming out. It started real tight, and it was me playing guitar.
And it's
what
just
that
this.
looks. Yeah, it's like what you're seeing is
Just make uncomfortable amounts of eye contact.
right in
Looking
the
way too
Yes.
heavy
on
about
the
that.
thing.
Perfect. Oh man.